And let me start with Karthik here. Karthik, now you have seen up cycles and down cycles. And what is your perception that if this credit down cycle on the markets, especially the credit markets, whether it's the traded credit markets or on the private credit markets?
Okay. Thanks, Arjun and INRBonds for having me. It's a pleasure to speak at this very august panel. As Nikhil introduced me, my background is more coming from the private side and now started to make entry into listed fixed income. So my perspectives are likely to come from that flow. But the answer to your question is sort of in 2-3 ways. At the outset, I feel the topic does say credit down cycle, but you actually step back and take a look at the market overall from an India perspective. India's GDP is roughly $3.5 trillion or so dollars. And the cumulative amount of credit, whether it's bank, NBFC, MFs, various other constituents of capital suppliers, sort of adds up to 2.9 or 3 trillion. So there is still somewhere in the region of 0.8 to 0.85 times debt to GDP, which in the way I look at private markets or the overall markets in general is extremely positive from an India perspective. So I think, this is a long-term play from a fixed income debt perspective. So while, yes, there will be cycles up and down and so on and so forth, I think the overall perspective that somebody who's a credit investor ought to have is that this is a longer term gain. And over the longer term, India is very, very favorably positioned as far as credit is concerned. Now, coming to the various factors, there are people who are economists on this panel who are way better than me in terms of correlating liquidity, inflation rates, and so on and so forth. But my take of it is the fact that perhaps it is this market compared to earlier cycles is a little different in the sense that in the earlier starting GFC onwards, the developed market inflation was not such a great risk from a developed market perspective. It was a real factor from a developing market perspective. So we had to deal with it. But right now, if you see, inflation is a global risk. So it's not just contained within developing markets, it's across the world. Even if you see some of the comments that are coming out of the recent US elections and so on, it points to the fact that there are various countries who are likely to continue to import inflation. So from that perspective, obviously, different markets will react or different regulators will react differently to it. My own view is that, interest rates, obviously, in terms of long-term 10-year yields in the US have gone up and refusing to come down, they're still pushing up. So there is, very strong bias for rates not to come down, and in which case the liquidity is all sort of sucked out and going back there. But to compensate from an India perspective, you see 10-year rates are slightly dropped. So there is perhaps a little more flexibility that the RBI has, whose sole purpose over the last 5-6 years, as you alluded to, has been more to rather safeguard FX and protect the rupee versus really all the noise around rates and so on and so forth. So necessarily coming out of these sort of tangential views and so on, my own view as a consistent over 20-year investor in credit markets, is today that overall there is a positive. It has become a more credit pickers market. There are tremendous opportunities to invest into credit and start building meaningful positions, provided as an investor you have duration. So I think that is going to be quite important for an investor to look at duration. And from a cycle point of view, I wouldn't worry too much, in terms of, GDP slowing and so on, because our GDP estimates were, very aggressive in the sense, 7-8%. Obviously, China grew, at 9 to 10% for more than a decade. So it's no reason that we cannot. But even if a 7% growth were to become 5.5%, it is still one of the unique and few growth spots in the world. So it is fundamentally part of a growing economy where credit is required. So there are opportunities with a positive of a growing GDP with inflation, of course. My own view is that while RBI may have some flexibility, I don't think that they are likely to, reduce rates too much. As a result of which, there is going to be interesting opportunities both on the private and the public markets from a credit investor's standpoint. So that's sort of overall, my assessment of where, we are today. And so I think inflation is a common problem for everyone versus the earlier cycles.